the GDP value of 356 billion to give 14 billion, that number essentially means that if every single dollar of the growth in GDP was devoted to debt financing, Greece would have about $14 billion available to finance debt. Okay? Now, the public debt of Greece is 406 billion, which exceeds its GDP. Right? We already know that the debt to GDP ratio for Greece is 140%, so that number makes sense. Debt exceeds its GDP. The interest rate on debt is 7%, which is again an extremely conservative estimate, given the fact that at one point Greek bonds were trading at close to about 35%. Now the debt cost turns out to be 28 billion. You know, all that one has to do is compare, to make this even simpler, compare two other very simple numbers. Compare the growth rate, 4%, interest rate on debt, 7%, essentially unsustainable. There's no way that a country which has public debt that exceeds its GDP and interest rate on debt that exceeds the growth rate can possibly survive bankruptcy. The fact that you had a whole bunch of international banks talking about saving Greece from bankruptcy is patently absurd. And the whole idea of trying to save Greece from bankruptcy is essentially a question of trying to save many of the German banks and the French banks that had lent huge amounts of money to Greece.
But what will happen if Greece will declare bankruptcy?
Many of the
and
loans,
they will be able to solve their problems like what happened in Argentina and Mexico.
I think
but the problem of Greece, is the euro itself. Because
right.
the euro doesn't belong to them, so they cannot do anything about it.
Right.
So they got stuck. And that's where their problems lie.
Right. I think that that getting out of the euro is probably one possible path to solve Greece's problems.
Yeah, they can declare bankruptcy, and then all these debt for the European banks, they are part of the community,
yes,
and they can restructure themselves again.
Absolutely.
And bounce back.
Absolutely. I think that makes a lot of sense to me. In November of 2010, Ireland began encountering problems. In Ireland, the era of cheap money led to a housing bubble which morphed into a banking crisis. Portugal, a perpetually underperforming economy, began to face debt problems as the interest rates at which it could borrow began rising. In January of 2012, Standard & Poor's cut its sovereign bond rating to junk. The Italian and Spanish problem. By the summer of 2011, the contagion had spread. Italy and Spain began encountering problems. Italy's problems arose from the debts it had built up prior to joining the euro, and Spain's from a housing bubble. The unemployment rate in Spain is currently 24%, comparable to the depths of the Great Depression in the United States. The unemployment rate among youth in Spain is an astounding 50%. It is important to recognize that the problems this week emanating from Spain constitute a vicious escalation of the euro crisis. Spain has $273 billion in failed real estate loans, a sum comparable to the entire GDP of Greece. So the fact that Spain is in trouble represents a major escalation of the debt crisis. Okay, before I go on to the next, to the Greek case, questions, comments, observations? All right, let's take a look at the Greek case, which is an extraordinary case because in microcosm it represents some of the problems with what's been happening in Europe. Anyone recognize that? Any chance? Can recognize that? Great Greek tragedy. Sophocles' Oedipus Rex, actually, which gave the term Oedipus complex. Okay. Michael Lewis, author of The Big Short, points out that the tsunami of cheap credit that rolled across the planet created opportunities for societies to reveal aspects of their character that they normally could not afford to indulge. Here's a quote from his article called Beware of Greeks Bearing Bonds. Americans wanted to own homes far larger than they could afford. and to allow the strong to exploit the weak. Icelanders wanted to stop fishing and become investment bankers, and to allow their alpha males to reveal a theretofore suppressed megalomania. The Germans wanted to be even more German. The Irish wanted to stop being Irish. Each responded to it in its own peculiar way. No response was as peculiar as the Greeks, however. In addition to notoriously lax fiscal management, Greece has a history of falsifying economic data. The latest estimates place the national debt burden at about 250,000 for every working Greek. The IMF points out it wasn't even what you would call an emerging economy. It was a third world country. That's actually kind of insulting to third world countries. Greece's public sector is notoriously inefficient. In addition to being inefficient, the public sector in Greece paid almost 3 times what the private sector paid. The Greek National Railroad generated annual revenues of 100 million euros, while annual expenses was at least 700 million euros. The wage bill alone was 400 million euros in addition to other expenses of 300 million euros. A former finance minister of Greece noted that the Greek National Railroad was not just bankrupt, it was bankrupt beyond comprehension. In addition to the inefficiency and waste that characterized the public sector, tax collection in Greece was notoriously lax. A former minister pointed out that the first thing that a government does in an election year is to pull the tax collectors off the streets. The Greece that gave medicine, the Hippocratic Oath, had an estimated 2/3 of doctors who paid no taxes whatsoever. Even doctors making millions paid no tax. A tax collector pointed out that if the law was enforced, every doctor in Greece would be in jail. The Greek system was set up to enable the entire society to cheat on its taxes. One of the most extraordinary aspects of the Greek case is the fact that Greek banks, unlike US banks, were almost blameless for the financial crisis enveloping Greece. Greek banks did not trade derivatives on a large scale or invest heavily in subprime bonds. The biggest problem faced by Greek banks was that they lent 30 billion euros to the Greek government with no certainty of the money ever being returned. In Greece, the banks didn't sink the country sank the banks. Okay, that's all right. Before we move on to the crisis, any questions, observations about the Greek case?
You mentioned cheap credit. Who was responsible for the cheap credit?
Well, the cheap credit was a problem caused by many different things. A monetary policy in the United States, the fact that the Chinese were generating huge saving surpluses, the fact that the Indians were generating saving surpluses. So it was not the problem of any one country, but thinking of low interest rates as being a problem is not perhaps an appropriate way of looking at it. Low interest rates is actually a wonderful thing.
But if you read the Western literature, they always blame the Arabs for this cheap credit. Many of these oil-producing countries, they have so much money, they didn't know what to do with it. They put it in European and American banks. And that's why at one point, these banks, they found themselves, they have so much money, they don't know what to do with it. And that's why they start lending at a zero interest rate to anybody who is interested. And this is exactly what happened. You mentioned the subprime problems in the United States. So these countries indirectly probably they contributed to this crisis, and they're going to pay dearly for it, because most of the money they put in these countries, they will never be able to get it back.
Okay. The causes of the crisis. Right. There are 4 major contributory reasons for the crisis. The first one that he's pointing out: low interest rates and resulting cheap money that led to debt binges and bubbles, especially in housing markets. First one. Second reason for the crisis is the lack of competitiveness. Third, the one that I want to focus upon most is policy errors, economic policy mistakes. And finally, inherent problems in the euro system. All right, let's take a look at the first one, debt as alcohol. One of the most significant benefits of the euro was the economies of scale it encouraged, which was reflected in a low interest rate for the eurozone. Capital poured into countries like Spain and Ireland, fueling stock market and housing bubbles. But cheap financing, like alcohol, can lead to long-term adverse effects. The current crisis in Spain right now is driven by a massive housing bubble. Many economists have attributed the easy monetary policy of the last decade, primarily Greenspan's legacy, to be the primary cause of the financial crisis. But this is in fact not a correct way of looking at things. Low interest rates are not a problem. Low interest rates actually constitute an extraordinary opportunity to finance long-term investment at a very low cost of capital. And you know, one of the traps that we often fall into is that when something is repeated several times over, we often fall into the trap of thinking about things in a very negative kind of way. Low interest rates is not a problem. It's actually an opportunity. And here is something that I calculated for the US Federal Reserve Bank. This is something that I call the implicit interest rate on US debt. In essence, what I did was I took a look at the amount that the United States pays in interest expenses every year and divided that by the total amount of debt to calculate something called an implicit interest rate. And it's very clear that from 1988 onwards, there's been a fairly sustained drop in the cost of capital. The cost of capital has been dropping from a little over about 8% to right now to about 3.05%. This is an extraordinary opportunity. It's an extraordinary opportunity for countries that are in a fairly strong position to redress all kinds of imbalances. At the end of trading yesterday, the yield on the benchmark 10-year US Treasury note was 1.66%. That's an astounding rate. And I went back about 200 years to take a look at the interest rate path of US Treasury notes, and I could not find a rate lower than 1.66%. Now assume that the US adds $100 billion in new debt financed by 10-year Treasury notes. The debt financing cost per year is then equal to you're borrowing $100 billion at 1.66%. So that means that you're paying interest of $1.66 billion. According to the most recent estimates, the US deficit is about $781 billion. Thus, an additional $100 billion in new debt will increase the deficit by 0.21%. That's 1/5 of 1 percentage point, essentially a rounding error in the US deficit. As a percentage of the GDP of the United States, which is about $15,000 billion, the annual financing cost of $100 billion in new debt would be even more negligible, what bond traders would call 1 basis point. That's 1% of 1%, $1, 1 out of every $10,000, a very, very small amount. Okay. The preceding analysis actually overstates the effect of new debt also. In other words, what I'm trying to point out is that even the 1.66% interest rate on debt is too high. What have I not taken into account? Why is the actual cost even lower than that? What am I driving at?
Inflation.
Yes, exactly. I mean, it has to do with not so much deflation, but the close cousin of deflation, which is inflation, actually. If you take inflation into account, the interest rate here is 1.66%, right? Suppose inflation is also 1.66%. What's the real cost of debt? Zero. It's essentially zero, right? What has been the historical interest rate, or what has been the historical inflation rate in the United States? 2%. So the United States can borrow at 1.66%. The 10-year inflation rate is about 2%. The US can't lose. It doesn't make any sense not to borrow.
But can I maybe ask Professor Wajih to make a comment? If the prices of, the cost of investment is so low,
right?
Professor Wajih is professor of finance, and he teaches students that there is an inverse relationship between the prices of bonds and interest rate.
Right.
And here interest rate is so low. So the prices of bonds so high, investors are not willing to invest.
Right.
So that simply means, Professor Wajid, is there any comment?
Well, it is well known actually. There is an inverse relationship between the interest rate in the market and the price of the bonds.
Absolutely.
If the interest rate is going to go up, then the price of the bond is going to go down.
Absolutely.
So which means we are talking about the yield to maturity.
Right.
So if the yield is going to go up, then absolutely the price of the bond is going to go down.
Right.
So that's well known, well documented.
Right.
So what will happen to these governments' bonds of Greece and other European countries now?
No one wants to hold it. Right?
So nobody wants to buy
Hold
it.
it. Right. Well, absolutely. The question down here is not so much the debt of countries like Greece and Spain, but countries like England, for instance, where there seems to be an obsession about cutting debt and cutting deficits. England has an exceptionally low interest rate. Germany has a very, very low interest rate. The US has a very low interest rate. So these are countries that are very well positioned to take advantage of the extraordinarily low cost of capital.
But you mentioned the United States, and they have $1 trillion of debt.
Right.
Do you think the American will care? They don't.
Right.
You see, the American, everybody else will pay for them. You see, every time the American dollar gets sick, it is the Chinese and the Japanese and the Arabs, they rush to fix it because all their investment in dollar. So that's why the American doesn't care whether they have debt or not.
Excuse me?
Sure.
Can I ask a related question?
Sure, please.
But the US economy is so bumpy at the moment. How come the US dollar has been appreciated?
Why has the dollar been a bit? Precisely because of this. Where else are you going to put your money? Where else?
Is it because of the comparatively weaker or bumpier economic situation in the Eurozone?
The world is pretty messed up. The US is less messed up. That's probably the way
it's a
to
comparative.
Exactly.
Dollar strengthening is euro weakening. That dollar price.
That's the same thing, right? I mean, yeah.
How they can benefit from lowering the interest rate?
Who can benefit from lowering the interest rates?
The Europe countries.
Right.
You said they will lower the interest rate.
What I was pointing out here was that the interest rate for United States treasuries, which is the rate at which the United States borrows from the rest of the world, that rate is exceptionally low right now. And I think you are pointing out that the interest rate on 2-year German treasury notes is 0.06%, right? What's it for the 10-year note?
German? German is 1.41.
1.41, which is actually slightly lower than the US rate.
US was 1.46 last week.
Right. This is yesterday. This is something that I looked up this morning.
But he asked the question, who will benefit from lower interest rate? He's a student, and that's why he's coming here.
Okay.
So
Who will
he
benefit
needs a
from
good
the lower
answer.
interest rate?
Yeah.
The United States. The United States will benefit from lower interest rates because it's able to think of yourself as being a homeowner, right? Supposing you're able to borrow, let's say, 100,000 BD at 3% interest rates, you would certainly benefit. The lender may not benefit, but you, the borrower, would benefit. Right.
No, but if you look at it from another perspective, the capital flows and inflows.
Right.
You see, so if you have a country with such a low interest rate,
Right.
you're going to have capital outflow.
You'd have capital.
I mean, why you have to be in a country that you are paid zero return on your investment?
So it's basically the interest rate differential that really drive what Dr. Ahmed was saying. With the low interest rate, people look at the currency with the you cannot really benefit the thing.
Right.
So that's why all the investors try to look at the interest rate differential.
Right.
Try to move all the capital to the place where you can get a better return.
Right.
That's can explain by.
It's called the interest rate parity theorem.
Parity. Yeah. It's differential.
Sure.
Because just to comment to the interest rate, I think when GDP is depressed,
Right.
I mean, when the monetary policies, you have to lower your interest rate to force investments.
Yes, absolutely.
And since investment is part of the GDP,
Right.
maybe the only way is the more rational way is just first lowering the interest rate.
Right, and which is what the United States has been doing, right? The US Fed has promised that until 2014, interest rates are not going to go up. The current interest rate, for instance, my mortgage rate my 15-year mortgage rate is 3.25%. I mean, that's an extraordinarily low interest rate locked in for the next 15 years, right? So you can imagine the effect on student debt, car loan debt, and so on. And that's the way that the Fed tries to stimulate more investment. And actually, talking about what you were talking about with regard to investment, I actually have something that's very closely related to what you're pointing out. Okay, the preceding analysis overstates the effect of new debt, since everything is analyzed in nominal terms. With inflation of say 2%, the real interest rate could easily be negative. The crisis viewed from a different perspective is an opportunity, and I think it's very important to remember that low interest rates is not a problem, it's an opportunity. All right. Okay, the second reason for the crisis is the lack of competitiveness. There is little doubt that the PIGS countries suffer from a lack of competitiveness. In many of these countries, doing business is complicated. The World Bank estimates that it takes 77 days just to get electricity hooked up in Greece. Powerful unions, archaic labor laws contribute to inefficient labor markets and high wage costs, but structural reforms are very difficult, primarily because cutting wages is guaranteed to the elections. All right, let's take a look at the last section, which is really about policy errors and and systemic problems with the euro system. Okay, I want to talk about austerity as an economic policy. The most commonly prescribed medication to combat the euro crisis is austerity, belt tightening, lowering government spending. Germany and France under Sarkozy pushed for cutting government spending and reducing debt. But imposing more and more austerity on countries like Greece makes little sense. A country cannot pay its debts if what is left of the economy is slowly strangled. Austerity as an economic policy completely violates basic economic tenets, and in any basic macro class, this is one of the first things that we teach. GDP is equal to C is consumption spending, I is investment spending, and G is government spending, and NX is exports, right? So basically that's a map of how an economic system works. Essentially GDP comes from consumption spending, investment spending, government spending, and the difference between exports and imports. Now, in a financial crisis or in a recession, essentially what happens is that consumption drops, okay? In the United States, consumption is 70% of GDP. So a drop in consumption is something that the Fed takes extremely seriously. That's the reason why we have low interest rates, to get people to buy houses, to get people to buy cars, and so on. Now, in a financial crisis, as I think he pointed out, investment also drops, right? So you have an equation, you have an equality. GDP is equal to C plus I plus G plus NX. C is dropping, consumption is dropping, investment is dropping, exports is also dropping, because you just can't export that much to the rest of the world, which is also in a crisis, right? So if three components of GDP drops, GDP is going to drop. So what's the solution? The solution is actually a very, very simple solution proposed by Keynes nearly 80 years ago. The solution is very simple. Essentially, you increase government spending. Right? If you increase government spending, GDP goes up. But the boom, not the slump, is the time for austerity, declared Keynes, who is probably the greatest economist who ever lived. However, today governments seem not to heed this common sense advice. The focus on cutting deficits at a time of recession is simply bound to deepen the recession. Greek highlights the futility of such programs. In the last couple of years, the Greek economy shrank by 12% and is expected to further shrink by 6% in 2012. When you think of systemic problems with the euro system and the way that you go about addressing the deficit crisis, there are really only three options available to you with regard to addressing deficits. One is you have to increase taxes. That basically revenue has to go up. The other is that you decrease spending or your expenses. So, and the third option is devaluation. Is devaluation available to the euro countries? No, because they all yoked to the euro, right? So devaluation is not an option. And you can't increase taxes, you can't decrease spending in the midst of a recession. So the only option for countries who are in the middle of a recession to address their systemic problems is to devalue, but that option is not available. An exchange rate system acts like a safety valve. When a country's relative prices rise, the exchange rate devalues.